Donald Trump has once again threatened tariffs against trading partners of the United States. This time he's vowing 25% tariffs on automobiles, semiconductors, and pharmaceutical drugs coming into the United States. But the market reaction has been muted. Let's talk about it with an expert in rates and currencies. He's Karl Schamotta, Chief Market Strategist at Corpay, and he's in studio this morning. Thanks for coming in, Karl. It's good
Absolutely,
to see you.
great to see you.
So, first of all, is it clear that this is a new tariff threat, or is he essentially repeating and recasting earlier tariff threats?
Sort of a modification on things that he said before, a little bit more precise around the details, at least in terms of the deadline. This time he's saying that it would be April 4th. That was, slightly different than what he'd said previously. But yeah, currency markets at this point are shell-shocked, right? There's been so many of these threats.
Right.
So many of them have been walked back in like one way or another. They've been paused, they've been reversed, they've been delayed, all sorts of things have happened. And so each of those times that has happened, that we've had this, sort of outsized threat and then this eventual climb down, currency markets have reacted very badly initially and then recovered. And so traders, speculators, and other market participants are growing more cautious about trading too much into each of these catalysts. They don't want to take losses when the story inevitably pivots.
How have markets responded in the past, in the first days of the administration? And he, in fact, made his initial tariff threat before he even became elected.
Yes.
So what kind of currency market reaction did we see at that point?
Well, at that point, we saw basically the targets of his threats selling off. So the Canadian dollar, the Mexican peso, the euro was a big faller at the time. The Chinese renminbi, simply because it's state managed, did not reflect a huge, big move, but implied volatility across currency markets also surged. So we basically saw two spikes, one around inauguration and the second around February 2nd, when that executive order was signed, and the run up to and the day after that. And so big moves, 1 or 2% in the value of a country is a pretty big deal. And so we saw those moves, but we saw them really unwind very quickly. And now we're seeing a pretty steady sell-off in the U.S. dollar relative to every major currency. Essentially, the Trump trade is dissipating as we speak.
Talk more about that, because that affects all the other currencies, and it has big implications throughout markets, the decline in the U.S. dollar.
Yes, I think the big story here is essentially that markets are looking through the rhetoric, and they're looking to what is underlying all of this, what are the motivations that Trump is following. And it is kind of fascinating because, if you go back to the 80s, there's interviews where Trump is talking about tariffs, like 25% tariffs on major U.S. trading partners. So he essentially has not changed his tune, right? But when you look at like what the other administration officials are talking about, what they're saying are the reasons for these tariffs, we've seen everything from fentanyl to immigration to trade imbalances, all sorts of things that kind of get thrown in there. Even defense spending gets thrown in there sometimes. And the reality is that none of those would be addressed ideally through tariffs. And tariffs would, potentially impact the U.S. economy in a negative fashion. So what really seems to be the bet that markets are making at this point is that although Trump is going to continue to issue these threats, and we may see some tariffs implemented around the margins, the reality is that the administration understands the negative effects and that they are not going to go full bore into a trade war, as had been feared, a couple of weeks ago.
And is that your view? Do you think markets are correct in taking that view?
Broadly, yes. I think that ultimately we're going to see these walked back to some degree. I think the rhetoric will not match the reality. But the unfortunate, dynamic for traders in the Canadian dollar, traders really in any kind of financial asset, is that we are still going to see spikes. We're going to see, episodes of fear, spread across financial markets. I often think of, the idea that you should anticipate the anticipation of others when we're thinking about investing or we're thinking about markets. And the reality here is, although things look relatively calm right now, it will take very, very little for that calm to be broken. So implied volatility or volatility expectations should be higher than they were, prior to Trump's second term beginning.
Okay, the Canadian dollar during the Trump administration has traded briefly as low as 67.6 cents. It's now above 70 again, but we still have a scenario, surely, where the Bank of Canada is expected to cut rates more frequently and by more in aggregate than is the Fed. So what is your view on the Canadian dollar?
I do think that the rate path has largely been priced in. I don't think the Bank of Canada is going to have much sway over currency markets for a while, simply because the expectation is that they will deliver 2 more cuts this year, just on the basis that inflation is well under control, underlying economic growth is weak. There's a lot of slack in the economy that justifies cutting rates a couple of more times. But the rate differential between the U.S. and Canadian dollar has started to stabilize. Right, we're not seeing it widen out any further. In fact, it's beginning to narrow a little bit on the expectation that potentially the Fed at some point needs to think about easing at some point, right?
That is Karl Schamotta. He'll be with us.